is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us.
Hi there, everyone. Welcome to today's Family Office. I'm Kat DeLillo, here to co-host our event with our CEO, Hall Martin, who's going to be talking a little bit about 10 Capital and what we do here. Hall?
Great. Thanks, Kat. I want to thank everybody for joining us today for another great presentation from both our panelists, Brian Woods, as well as our companies. Before we jump into that, let's talk more about 10 Capital and who we are. We want to welcome you to our today's virtual event. We, at heart, we help startups and investors connect for funding. We're basically built on that. And so what we do is we help companies get ready for fundraising. We coach on fundraise strategy, revamp pitch decks, and revamp positioning, and do many other things that help them. We identify investors that are interested and then set up engagement online, in person, and on dinner events. We've raised over $900 million since we started 12 years ago when we originally were named Texas Entrepreneurs Network. But in short, we provide the legwork and save you time and money. So at heart, our mission is we are forming capital for early stage funding. We help high net worth individuals launch family offices. That's the purpose of today's event. The Family Office Roundtable is focused on topics related to high net worths who want to start family offices, or family offices who want to know how to run a family office program. We also help VC funds find limited partners, mostly family offices. Family offices fund emerging managers, which is a critical point in the startup ecosystem. And finally, we help angel groups find members. As an angel investor myself, I can attest that an angel investor will do much better in a group than they will by themselves, because I found when I was doing it alone, I spent all day finding the deal and I spent all night doing diligence on them, and really have to share that workload as best we can. So we help angel groups find members. Have done that with about a dozen different angel groups, C10, Frontier Angels, Keiretsu, and many others have used our resources to find more members for what they're doing. So in addition to the Family Office Roundtable, which you see up there, and that's what you'll have here today, we also have the Quick Pitch. It's also a 2-hour online event with companies pitching. Each company has 10 minutes to pitch, 5-minute Q&A. And the Quick Pitch is for technology-based companies. About half our deal flow is in that space, with a lot of emphasis on AI. The other half of our deal flow is life science, and that's for the Life Science Syndicate. And these are people that are on the FDA path, biotech, therapeutics, med devices, diagnostics, and the like. And if you want to learn more about 10 Capital, just go to 10capital.group and you'll see there's a button for events. Click on that and you'll learn about our events and what's coming up. If you're a startup, go ahead and take a picture of that QR code and fill out the form and send it to us. And we'll check to see if this is a fit for our program and see if you can benefit from our fundraising efforts. And we'll be back in touch with you afterwards. Next slide. And finally, we have a podcast program called Investor Connect. And we've had over 800 interviews with angel VC family offices that talk about what they invest and how they invest in startups and early stage companies. And we also have what's called the Startup Funding Espresso. In the time it takes to drink an espresso, you can learn something about startup funding and investing. These are 300-word micro blog posts with about 1.5 minutes audio. And we've done over 2,000 of these. And when AI came along, we decided to put all of them into our own LLM. And so you can actually ask a question to our chat bot, which we call Ava, and it just gives you a synthesized answer. No more just getting a bunch of links. You're now actually getting the answer you want. And so this is a great step forward, and love to have you do it. Let's hear more about it from the video.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. So with that, let's go ahead and get started. Our presenter today for content is going to be Brian Wood of Wave Ventures. He comes from the deep tech space and funds deep tech startups, and we'll hear from him here in a moment. After that, we'll have 3 companies that are pitching. We'll have to get your guys' feedback on it, and we'll wrap up the day with a series of breakout rooms that you can go and talk to any of these people that you see here today. But with that, let's bring up Brian. And Brian, if you go ahead and launch your slides and tell us more about Wave Ventures and your background.
Well, Hall, thank you. I'm very excited to be here today and to share with you a little bit of the kind of the evolutionary story of kind of our innovative model and how we've, begun what we do at Wave. Wave is actually a moniker for Waco Ventures. You'll find out in a minute, most of our story began in Waco in partnership with Baylor University, but it certainly expanded out from there. But before we dive into all that, I do want to say a great thanks to Hall. We recently have been connected through some common friends, which is always the key. We say at Wave all the time, everything moves at the speed of relationships. And Hall has very uniquely created a network here with 10 Capital that's, very, very efficient and being able to connect with people. I was able to attend one of my first dinners with 10 Capital just a few months ago and already have significant and fruitful relationships that are burgeoning out of that and helping not only at the firm level, but several of our portfolio companies and things that we help, advance to their goal lines. And so very, very excited to be here, to be a part of this and to get to meet some of you today. Today, we're going to talk a little bit about the deep tech innovations and how we have begun our firm around university and university tech transfer. Today, you're going to learn a little bit about how we have built those relationships now with multiple universities, the unique model under which we engage those universities and participate in their intellectual properties. But perhaps most importantly, how do we take and mature technologies that are in certain TRL states, along the journey of 0 to 9, getting from an idea all the way out to the marketplace. But in addition to the maturation, what we do specifically at Wave is we not only source the technologies, we then build the companies and the talent around them in order to get them to market. And you'll hear about several of the strategies that are here. So let me dive in. All the information and slides that we're going to present today, you can certainly get a copy of from Kat or from Hall after the process. But we are, an initial fund. You'll hear about our team here in just a minute, but we went to market late 23, long time to be raising an early stage technology fund. Certainly you might say out in the marketplace, but we're very blessed to get out and launch a small $25 million fund. We were able to oversubscribe that to 31. In addition to this fund and some of the unique modeling that we did with our universities, you'll learn about some of the other companies and investments that we've been able to do. Total for Waco Ventures, we're just under 100 million. They launched right in the middle of the pandemic in 2020 year, but we've been able to cross this particular fund to launch 10 portfolio companies out into the marketplace. 50% of those, 5 of those are direct source deep tech coming off of the university campus. And then the rest of the fund, we've sourced just regular things along our expertise and some of the other pieces there. I'm going to explain to you in the model just a minute, but we've got some significant opportunities in a de-risked environment to have a significant TVPI and a nice 30% IRR over the course of everything that we're doing here. And we'll cover this in more depth here in just a second, but what we've done is we've developed this venture firm in order to fund these vehicles and create significant returns for our LPs. What we've also had to do was build an ecosystem that we now call Tech Transfer Studio, which is the science and the diligence process that comes alongside all of the services at the campus to be able to make sure that the right technologies are chosen and sourced, the right technologies have a company built around them correctly, and that the right strategies are being used in order to get them out into the marketplace. So I'm excited to dive in and tell you about all of that. Before I move into the actual model and how the kind of the unique evolution of it came, let me pause this, give you a little bit of background on me for context. I should have done that right at the top, but pretty new actually to the venture space. Just to be honest with you guys, I didn't ever plan to be in this particular role or doing what I'm doing. I actually started out life as some of the pictures here, and I was talking with Ray and some of the guys earlier. I started out life in the professional music world, was a musician, touring musician for a good amount of time. Did get to go to my undergraduate school on full music rides in order to do that with jazz and some other performing arts areas. I met my wife of 31 years at that university. I met her father, and there was a need to do something other than just be a musician in order to win the girl. And so I had some great advisors in my life, and they advised me to go to medical school. So I wound up deciding in the mid-90s to go to medical school. Did get to go to school at University of Texas down in San Antonio. Wound up in the military because most of San Antonio is a military town. Many of y'all probably know that. But I wound up in the Air Force. I did aerospace medicine for about 7 years with the B-1 bomber unit. And then after getting out of the military in 2003, I was able to come back here to Dallas, Texas, which is where I'm from and where I'm based currently. And did my anesthesia and pain management residency here at UT Southwestern over at Parkland Hospital. Joined a small company called North Star Anesthesia in 2007 when I got done with my training. And then just like many of you, being a serial entrepreneur and interested in building and growing and scaling businesses, I was very blessed to be a part of the team that took that company in 2007. We were doing about 14 million top line with about 11 contracts, here in the Dallas-Fort Worth area. And then over the course of the next 15 years, we'd scale that to about 1.5 billion nationwide, 273 hospital contracts, 28 states, and every possible negotiation, merger and acquisition, and technology roll-up process to create a business with that scale. I got to be involved in those places and learn a lot of lessons along the way. We exited multiple times through private equity. First was to TPG Capital back in 2013. We exited the long-term capital in 2018. We're called Creamier Capital, based out of London and New York and DC. It was after that acquisition that I had a lot of fun doing the merger and acquisition plays. And so I started getting involved. I was in consulting and helping small businesses. And that's when I met Alan Page, who was, you'll find out here in many ways, the architect of some of the model we're about to dive in. So in 2020, he invited me at the request of Baylor University eventually. And then with Wade getting started and expanding out to other universities, we got the opportunity to build kind of this unique model and process we'll explain. So let me dive into that model and tell you what's going on here, kind of at an overview of what we do. This slide is just a very quick illustration to show you how we differ from a typical traditional VC, fund strategy approach. So we all know the process. You find a VC investment, you start looking at potentially placing some capital in that. Every early stage founder and VC has our early stage founder and venture has, a lot of beliefs in how beautiful their baby is and how special and process it is. And so, you place some capital in that particular situation. And if it's a passive situation, you might wind up with a 20% stake, for just a capital placement. Oftentimes there's a lot of people telling that inventor or that founder or business creator, how nice they are. So it can be a competitive process to even get to the point of getting to the deal terms and getting that done. Typical fund making, let's call it 10 to 12 plays, you're going to be looking for a winner and some that'll cover, and then you're going to take some losses because it's early stage VC. And so you're looking for a typical TVPI of, 1.5, 3 times over the course of the fund life on a 7 to 10 year play. And then if you're in the early seed stage and you go through seed and then series A and then potentially an eventual series B, you're going to go through additional dilution after initial capital position. So maybe you start with 20, but you end up at 15%, maybe less, depending on the structure and the valuation process through that world. What we have at Wave is a very unique model that offers the following. One, we start the day as LPs in these startup companies with over 80% of the cap table. I'll explain how that's possible here in just a second. Because of our unique relationship with universities, which I'm about to unpack, we have a very proprietary deal hunt and seek process, and then we literally get to cherry pick and work on the technologies that we think have the best market addressability and the ability to get to market and hit their returns and their numbers. Because of that, just in our initial fund, which you'll hear about several companies here in a little bit, but in our initial fund, we're projecting over a 7x, and in many cases, even our earliest stage companies that we're now 5 years in cycle on, we're still holding upwards of 68, 69% of the cap table after Series A and Series A dilution. And so for our initial LPs that come in on these models, it creates a very unique environment to where we have the ability to basically take the LP investors get to take the founder equity stake at the beginning of the model. But because of our process, we also get to do that at a very de-risked position. Many times these companies will have been at the university level or having some level of investment, sometimes non-dilutive capital in the form of grants, investments, other types of accelerations to try to get the technology accessed. And when we get the opportunity to play with those particular companies, you'll see in just a second, we have a 6-phase model by which we're able to de-risk when we deploy capital against those companies and make that process tick. And so this unique model is good for LPs and investors and those that are looking for diversified placement of their capital. But the next question is typically, why in the world would a university want to do this particular model? And that really comes down to this slide here. So here are the 5 reasons we found that first Baylor University wanted to do this, and then we have engaged with the remaining logos and processes that you see here. First, let me tell you the story at Baylor and kind of how this all got started. You know, you guys might remember back, Baylor had a little bit of controversies on the campus with our brows and some of the football players. There's a whole bunch of cultural stuff. There wound up being a massive leadership shift, leadership transition at Baylor. And President Livingstone was brought in 2017-18 timeframe to come in. And after doing her listen and learn tour, she reached the point where she said, listen, we really need to change some of the focus and the major pillars upon which Baylor was being built at that time. And she made a commitment to say, we really want to actually advance into the process of being a research-oriented university and drawing in faculty, students, postgraduates, and research dollars to the university in order to advance the mission at Baylor University. And so at the time, you probably are familiar with, if you're involved in tech transfer or university transfers and all, there's the entire Carnegie Mellon rating system. There's R1 status, R2 status, R3 status. At the time when we met and started the conversations with President Livingstone and the university, they were R nothing. They had a vision to get to R1 by 2026 was their initial goal. And after we got together and partnered together on the model that I'm about to unpack for you, gratefully, we started in 2000. At the end of 2022, they were awarded R1 status 4 years ahead of schedule on that process because of how this process worked for them. So let me walk through that desire for President Livingstone led to the opportunity. My partner, Alan Page, who some of you all get to meet in some other contexts and other positions, my partner happens to be a recovering CPA and an IP attorney, and he taught the mergers and acquisitions courses at the Baylor Law School. That is how we got invited into this conversation, because they came to Alan and they said, hey, we'd really like to advance our R1 status. We'd like to be doing more research and partnering with industry, partnering with market partners and investors out in the marketplace, but we just can't seem to make that connection, and we're not able to source and get these dollars to come into the university. After some time and several meetings, Alan was able to sit down and explain what we had was a disconnect. There was a misalignment of agenda and values and risk. And so because of that, he explained that, you know, until you get some of those things synced up, it's going to be really hard to attract appropriate LP capital coming in, you know, from a PE or a VC early stage environment. And they basically said to Alan, could you build a model that would make that more attractive? The model I'm about to discuss for you is what Alan presented to them late 2019, and it's how we launched our firm and created our entire process here. And so here's how that model works. The first thing that Alan highlighted for the university was, you guys are good at teaching and doing lab research and bench level research. You're not necessarily good at going to market, starting businesses, building businesses, scaling businesses, or negotiating with the open marketplace on how to do that. And so rather than typically, you know, doing one of two models, a lot of universities do what we call the faculty push-up model. You know, Dr. Jimmy built this widget. Dr. Jimmy's going to get supported by the university and go out. We're going to hope Dr. Jimmy knows how to start a company, found a company, launch a company, go to market and get the product market fit, and then get actual revenue to flow into that. That's a sub 0.05% chance that happens, because just because you're a great inventor or founder does not mean that you have the skills to actually launch a business. The other major model, which all of you are certainly aware of, is just a straight royalty licensing model. So you license out the royalty return approach on the IP to an industry, you know, large company or some other type of individual, and you try to collect dollars back on that. Where we started was, we said, let us create a business environment where we get the business experts, startup experts, scaling business and market fit experts, and bring them into the business around your IP. But we're not going to do faculty push out. We're not going to do licensed IP out. We're going to do full assignment models. That means that literally these universities assign the rights to the IP to the new startup, NewCo. And for that, they receive two things in return. The very first thing they receive is number 2 on this slide. They receive usually a 3-year minimum investment guarantee from the external startup company back into the university to complete additional research and follow-up investment into the development of the technology. Because this is a fully outside the university, non-university controlled, non-university governance entity, they get full R1 credit for every one of those committed dollars within those first 3 years. So they get those fundings into the lab, they get the research dollars committed. And even in the event that a company would fail, and knock on wood, we haven't had any companies do poorly at all, Even if that were the case, they've received 3 years of guaranteed funding into that organization, and they got their R1 status. This is what Baylor leveraged across multiple companies that we funded in the first 2 years. This is what Baylor leveraged in order to get their R1 Carnegie Mellon metrics up to the point where they were granted that R1 status 4 years ahead of schedule. In addition to the guaranteed upfront money, the university then receives an 8% simulated royalty position. So they get 8% simulated royalty all the way through development of the company and all the way through exit of the company. The university has no clawbacks. They have no block rights. They have no other portions of control within the governance of the organization, but they do receive that 8% royalty. So for every company that they put into the model, they get 3 years of guaranteed funding for the lab. And then on those companies that have a success and have a win and have an exit, they also get an 8% guaranteed royalty stake, which is typically 2-3 points higher than their historic or legacy style royalty models that they have done. So guaranteed money on the front side, better than normal royalty model structures on the actual simulated exit. And so for those reasons, and the de-risking of their position that they have other experts to come build company, run company, exit company, Baylor found that to be very, very successful. Thankfully, not only did Baylor find it to be successful, but you see the other logos here. Every one of the other logos that is on this screen has been an inbound request to us to bring our financial model as an adjunct to the ongoing tech commercialization processes that are going on at each of these campuses. So number one, we do assignment, not a straight licensing model. Number two, we give them guaranteed money up front with an 8% simulated royalty exit at the backside. Number three, we minimize the amount of founder effect that typically happens. When you have a founder that's created a baby or a widget or a new company or a new technology, and they think that the technology should be able to go 10 paces to the front, turn left, and then turn into a blue light, they think that's what's best because that's what they invented. But we as market experts and industry feedback from all of our experts, we're able to say, no, if you could go 8 paces, turn right, and turn red, then you've got a market fit that'll drive revenue and the sustainment of your company. And so we're able to reseat that founder seat with business experienced experts that have been around the block and know how those deals go. But we do have the opportunity to invite that particular inventor, founder, faculty into the company if they do have skill sets that are unique or ubiquitously needed into that company. So maybe they're the right person for the CTO position. Maybe they're the right person on the BD, conversations and doing some of the sales pitches. In those events, outside of the economics that we do at number 2 with the university, we can offer that faculty additional direct economics, incentive pool units, whatever that is. And so this combination of these 3 things, this is how we do our initial startups. 8% simulated royalty to the university, 10% management pool, sometimes 15% management pool, depending on the technology or the company. And so that's 18 points. And then we literally just took the other 82 and we put them into the founder LP equity stakes that we offer to all the investors that come into this particular situation. The next 2 are pretty straightforward. Most of y'all are in the space and how this works, but because these are coming out at early TRL stages, technologies coming from these campuses, TRL 3, 4, pre-revenue always, we're able to start the near zero valuation point so that our LPs who come in with 82% stake, they get that first major hockey stick lift once we get to Series A, product market fit, first customers, first revenue coming in. And so they get to, benefit from that valuation jump that happens in that particular situation. And as I stated earlier, traditional VC funds looking for 10 plays, they're looking for that one, good solid triple, maybe a home run, couple of companies to cover, and then they're certainly going to take some full-on losses in some of these. Because of our situation, currently at Wave, we're 5 years in, but we've had 0 companies go to 0. We've had all of them you'll hear about in a minute, but we got all companies are doing well and progressing in revenue. And right now, out of the 10 plays that we have at least 3, if not 4, still potential unicorns with $1 billion exit opportunity still ahead in this particular situation. So been a lot of fun. Maybe some of those logos you see there, maybe you have a history with or your affinity with or some other things, and we can certainly talk about that when we get to Q&A here in a minute and see if anybody has any questions about that. So that is the unique model that we have on the economic side. This is the unique arrangement that we take with our university partners and why it works for them along the drivers of their position on the university world, trying to grow their research abilities on campus. Let's talk a little bit about what do we do and how do we go through and source that. This is a very quick slide to show you that we have a 6-phase process that reduces risk at each stage and allows us to go through and be a part of the earliest identification of technologies when they go through an IP reporting process at Baylor or OSU or A&M or any of those locations. The process I outlined here is most ubiquitous to our Baylor location, but we certainly apply this process, to multiple variations with our different university partners. So while we don't get involved with capital or company building until phases 5 or 6 here later stage, we are getting visibility, activation, and input into the earlier 4 stages of this process. So initial identification and evaluation of the technology. Then product ideation fit. How are they going to take that through their initial MVP, some of their early stage TRL 3 and 4 developments? Most of the time, by the time we get to the point of putting in capital or proposing capital, we do have a pretty good, clear picture on the university's current IP position and what they've done to protect and create moats for that world. We have our own firms that come in and do additional work on the outside to help us with that as for those companies we did plan to take forward to financial investment. Stage 4, this is the point where we have a very significant partnership with a group called Breathless Innovation Partners. They act as our internal CTO or CTO team, and they work with each of our campuses and help drive the tech transfer studio model at each of the campuses that we're engaged with to validate the technology, get it ready for MVP. Often at this point, needing the money to kind of get through that valley of death, come through TRL 4 or 5, and then start pressing up towards getting the commercial products. And then it is at stage 5 here where we go through the process of doing the assignment, a negotiation with the university, identifying that technology, identifying the talent, the team, the location, the different resources that we'll need to build that company. We raise the funds or deploy those funds out of our raised funds or SVPs. And then we go to the work of doing the company building. Of course, that's where all the hard work is, and anything new takes a while to do that. But as you'll learn in a second, we've got a team of people that have been doing that for some time. So this is our process by which we work with our university partners to identify, de-risk, and then position the company ready for outbounding and company building. Where we go with our early stage investments is pretty straightforward. We typically play at a pre-seed level and they carry the company through multiple rounds. Series A and Series B, we typically will look for other institutions or firms to come along and run. Point on that, we maintain our position with the seed investors and go through that. We will invest as follow-ons, of course, into the companies that we have success to show, confidence and continue to desire for the company to grow. But we are looking for co-invest and lead investors at Series A and Series B, typically, which we've done. But for us, as we're assessing all of the different technologies that are out there on these campuses, I think there's over 43 or 44 that we're actively engaged with right now, studying and looking at. We're looking for things that are, can we match the right world-class leadership with the particular technology? Can we bring a real world solution, something that's not an esoteric, side niche style product, but something that's going to solve a real world opportunity? And can that solve and that leadership team be put together? Can we actually do this at some version of significant scale? Because of our past and the company and the team that we've been able to amass here, we're really looking for things that have, mass market addressability, usually a world level view, if not just a broad North American view in the process. Our team that's gotten together, and we got together in 19 and started putting all this together. When we started assessing all of our prior experiences and different things that we've done, we've realized that we had some predilections to be in certain spaces, healthcare being one of them because of my background and some others. But we had, just prior to launching Wave Fund 1, we had raised just under $650 million. We deployed that against 32 companies. And at the time that we started the fundraise for Wave Fund 1, we had already had 12 exits out of those 32, some of which you'll see here in just a minute. Already had an early stage CDPI and great advancement on that. But we'd been through the process of being the founder, being the executive, running the turnaround, doing the startup, going from 0 to 1, taking it from 10 to 100. We'd had a lot of experience in those particular areas. And so that group that you see here at the top, so the second bald guy there, that's me with my background, which we covered earlier there. That's Alan Page, the other partner who was kind of the architect for some of the financial and the approaches there. Spent a lot of time down in the Austin market with Austin Ventures and the DLA Piper and some other IP firms there. Since we launched our fund, Sean Limbers, who is also in Waco, has joined us as a general partner, comes with a significant background around real estate, some other large investments, as a large background for himself. We've added some other technology and studio accelerator type partners that have some experience. Travis Linderman just helped us secure MOU to work with the University of Michigan. So they will be added to our list in our process. And we've got a bunch of different operators and folks there, including Dr. Powell, who's also a recovering physician like myself, who built some technologies and IT technology monitoring systems so that they eventually exited Apple and Sequoia back in the early teens. So this is our investment team and the folks that lead up our selection processes. We also have a shared services unit that sits behind all of these different companies and investments. And we're able to fractionate out across all of that, the back office support services, even coordination with our IT attorneys, all those types of things, and do that at a fractional low cost advantage so that the startups don't have to bear that type of a burden, too large as they get their money put into their investment, developing their MVP or getting the product ready to go out to market. Here, you'll be able to see these slides later if you care to, but here's some of the examples of some of our products here listed in the boxes on the left and some of our exit partners. So we exited, Covidian or to Boston Scientific, GoPro, some of our deals there, pretty large. And then on the right side, you'll see a large number of the companies that we as operators had started. Many of them started from scratch, initial idea out to the marketplace, and then created the opportunity for those particular plays to go through exit. Very quickly, just a summary on what we do with our investment strategy and how we go about things. We have 3 different areas for our group of partners and leaders that we focus on. Of course, the first is medical tech and life sciences. As you'll see across our 10 companies that we have right now, there's predilection. I think it's nearly 60% of that is medical and life sciences. Because of our partnerships there in Waco and with L3Harris and some others, we have several companies in the aviation engineering space. Then we have several opportunities in the energy and alternative energy spaces. We started the fund in late 23. We did get closed subscription documents all the way to 31 oversubscribed. One of the individuals, which was a partner firm that we had done some deals with before, they had made a commitment for, I think it was 6, maybe 7 million. And to date, they've only been able to close a certain portion of that. So as of February 25, we have about the last $4 million in on this fund is available and open there. But you'll see here, we have target allocations of about $500,000 to $2 million. These are typically larger than you would typically see in an early stage pre-seed, technology play. A lot of times you're writing hundreds or 250 checks here, but because of our 3-year commitment and our roadmap plan, where we've already de-risked what we believe the go-to-market strategy can be, we do have a kind of a larger availability of cash to go into those particular rounds. We do have an emphasis here in Texas, but as you saw with the other logos, we are now starting to spread that around the country. And then we have covered the 3 areas on the right side why we focus on those particular things. Just real quick to give you a little bit of history about how we've done with this fund since it's gotten launched. As we closed out 2024, the companies that were within our fund already had a slight left to the TVPI and an IRR and just under 10 there. You can see the percentages of the different spaces in text, with obviously a large portion of them being healthcare, which you'll see here. Just with deals that we have on the table and rounds that are about to close here in the next probably 120 days, we're anticipating already at end of year 3 for the fund, TVPI at 1.5, and IRR will be climbing to just over 28 there. Across this fund, to show you some of the university technologies that we did transfer, these are the 5 companies that we have built, including at the bottom there, Tech Transfer Studio. We invested in and created a vehicle that takes what we built at Baylor University and now replicates that across our other university partner locations. But we've got some assets and some committed capital dollars in that particular studio in order to help advance the early stage portions of all of our university deep tech work there. But you'll see here, 6P Color is a new color expansion process for all digital displays. So anything that you look at digitally on the screen, whether it's a TV or projector, medical imaging, dashboards in your car, in your plane, whatever that is, 6P Color is going to have an updated process there. We have over 80 new patents on this particular technology and lots of really good things moving forward. i3 Breather is a novel ventilator system. It came out of the COVID pandemic era. And what we now have a vision for is a lay device. You might all think about the AEDs that you see on the wall at the gym and at the school and at your restaurants and everywhere that you go. This is an opportunity to introduce breathing back into the emergency response system, that a layperson can apply the device and then follow the instructions just like you do on an AED and restore normal breathing to a down patient with a respiratory or cardiovascular event. Verify Technologies is a company that does ultrasound detection of early stage polycarbonate fiber. Think aeronautics, think Boeing, think large scale processes. That company is now in year 4 and approaching just over $5 million in annual revenue there. Thule Aero is a very unique opportunity that we had come to us out of the United States Air Force Academy and some of the technology partners there at Baylor University. It's the first in over 100 years, first massive design update for propellers. And it has the unique properties of being able to decrease noise, which is a major issue for drones and delivery systems. You guys might be seeing the articles that Amazon and Walmart, and everybody's starting to think about drone delivery to, for final mile deliveries in your communities. This particular system is a proprietary unloading at the tip of the propeller that allows us to decrease noise, while at the same time that would typically lead to a decrease in thrust or energy advancement. This particular design has the benefit of both increasing efficiency and therefore drive, and therefore battery life and fuel efficiency on any plane, while also doing up to 70% noise reduction of the actual noise that comes out of that process. And they've developed an entire technology of building and modeling that allows them to build that in days, not months, for any type of new airframe there. So out of our 10 technologies, these are the 10 that we have directly sourced. All 5 of those came through the Baylor relationship and are active and ongoing companies. We now are in the process of preparing for Fund 2, which will be coming, but that will start to involve some of the new technologies coming off of our University of North Texas, Texas A&M, Texas, our Austin partners, and so forth. And then, as we said earlier, we do have a large number of companies that we have added to these 5. 3 of those 5, Precipio, Lassie Health, and Spork, all being in the healthcare environment. And then we have an alternative energy company, the ED in Motion, and the loyalty program here. We're going to take some time to go through each of those companies, but I think what I'll do now is I'll send this out for anybody that's there. But let me just say, each of these companies, all 10 that we have placements in, as I said before, 3 of these companies, Precipio, Lassie Health, and 60 Colors, you see right here, all of these still have significant chances for at least greater than 500 million, but if not billion-dollar market pieces. And that's not just me as a managing partner saying that, that's market feedback to us based on where we're at with those particular growths and opportunities. But I won't take time to go through each of the portfolio companies now. I think you get the point, but you'll be able to study these. And if you have any particular interest in these particular things, we can cover that at the end in the Q&A. But let me just advance through, some of these portfolio company pieces here. And I'll just get up to the point and just see if there's any questions or any clarifications that anybody wants to have with our approach to kind of D-technology and how we leverage that advanced LP position with the de-risk model, how we manage that into our fund and manage our flow here.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halty Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.